So we're up to Chapter 7 on receivables, and receivables are when people owe your company something. So the usual is that you have an accounts receivable. These are generally from your customers. You've sold some goods, they haven't paid you yet, and so you send them a bill, you have an accounts receivable from them. Other types of receivables would be notes receivable. These are more formal instruments of credit. You can have, customers who are promising to pay, but it's going to take them longer than ordinary course of business, and so you might want to have a note receivable from them. Notes are generally for periods longer than you'd have an accounts receivable, so periods longer than 30 to 60 days. Other receivables a company can have are due from officers of the company or due from employees who owe them money for some reason. They can have due from government agencies. Maybe there's a tax refund due, you can always hope. And possibly this interest receivable on notes outstanding that people owe you. So we'll basically look at accounts receivable and we'll look at notes receivable. You can break receivables further into this trade receivables and non-trade receivables. And trade receivables arise from transactions with your customers. Non-trade, just about from anybody else. So those are just important sort of terms to keep in mind as you're going through the chapter. Okay, so how do we get an accounts receivable? It generally arises from a sales transaction, and I'm going to just be using the example from the notes where it says on the 15th of January the company makes a sale on account for $120, net 30. So we'd say, okay, so it's the 15th, we made a sale on account. That means that they didn't pay for it, somebody owes us money, so we have an accounts receivable. So that would be debited. It is an asset account, and we would credit our sales revenue because that's what happened. And a journal entry is just telling the story of what happened in journal entry form. And it was for 120. Your book doesn't go into sales returns and allowances at this point, but I think it's important either to review that or to know that it exists if you haven't run into it before. On the 17th, the customer decides that some of the stuff just doesn't fit, and so they bring back $20 worth. We're not going to debit sales revenue because we want to keep track of how many returns we have. So we're going to have an account called sales returns and allowances. And then we just keep track of all of the returns. And that's a contra sales or a contra revenue account. So on the income statement, you have sales, less sales returns, and allowances would give you your net sales. Okay, and obviously we would reduce, we're going to credit the accounts receivable because the customer does not owe for the stuff that they returned. So that would be the $20 that they returned. Okay, so come the end of the month, customer decides to pay. Okay, so we get the cash and reduce our, I'm just going to abbreviate here, our accounts receivable. And the amount would be 100 because they owed 120, they returned 20, so the account receivable remaining would be 100. Okay, so there's nothing too bad there so far. Okay, so the next thing we have to look at would be, what if the customer does credit card sales? That's another form of receivables. And there's two different scenarios with credit card sales. One is it's the store credit card. It's the, it's their own credit card. And that's accounted for differently than if it's a national credit card, such as, MasterCard or Visa. So let's start with the store credit card. And the store credit card would be accounted for just the same as a regular old accounts receivable. Okay, so they're gonna, and I'm just gonna change this to, they just bought something for $100. So this would be if it's a store credit card. And the only thing you have to know about that is that, say the terms were net 30 and they hadn't paid by, the 15th of the following month, Well, then at that point, the store would add interest onto this. And so the other journal entry that's involved with a store credit card would be if they have not paid within the stipulated time, we would simply add on to that accounts receivable a certain amount of interest. Okay, so notice we're not debiting interest receivable, we're debiting accounts receivable, and it would be interest revenue. Okay, so the store is adding on, say, $2 interest, and they're booking the interest revenue. So when the customer says, oh gee, I'm a little behind, I better pay this, the cash they will send and the account receivable will be reduced for the 102, which is the current balance. Okay? So that's pretty straightforward. That's a store credit card. What if it's a national credit card? What's the difference here? This would be MasterCard, Visa, any of these. And those are accounted for slightly differently. Let me just draw a line across here to indicate that. So if we had the same sale on, let's see what I do here. Let's go with the, yeah, I use different numbers for some reason here. So say we have sales on a bank credit card, and the example here is the restaurant they ran up a $175 lunch bill, and the company charges a 4%, the credit card company charges a 4% fee. What does that journal entry look like? Okay, so basically you'd be booking the sales revenue of the full 175, but we do not debit our accounts receivable here. We're just going to be debiting cash, okay? And the amount of cash is going to be the sales revenue less that 4% credit card fee. So we're going to have a, whoops, we're going to have a debit to credit card expense or some such account, and that will be the 175 times 4%, which is approximately $7, and the cash would be debited for 168. Okay, so just make note of the difference between national credit card and store credit cards and how those are treated. The main thing students tend to goof up on exams is this right here, and it's pretty straightforward, but you know, people will be going, oh, interest expense, and you know, all kinds of crazy accounts. You have to think about what's going on, because the journal entries really just are describing what happened. And what happened was the store added interest onto that particular account receivable. Account receivable goes up, interest revenue booked. All right. Oh, the book also mentions installment sales. That's where customers have an arrangement to pay over a set period of time. The good news for you is we save that for future accounting courses and don't really get into the journal entries. You should just be aware of what they are. Okay, so the next thing we'll talk about will be what happens when our happy customers don't send us the cash. What happens when they don't pay their bills?